Did you know that you can sell certain types of real estate and completely defer any capital gains taxes that you would otherwise have to pay? This is Mary Hart. I am the founder of the Alternative Investing Movement, and today I'm going to talk to you about 1031 tax deferred exchanges of real property. So what is that? Section 1031 refers to a section of the Internal Revenue Code that allows you to sell certain types of real property and completely defer any amount of capital gains tax you would have paid if you were to sell the property. So what are those types of real estate that you can sell in a 1031 exchange? Well, that property that you own has to have been held for investment purposes or for use in a trade or business. So if you own a rental house that you've held for some time for investment, you want to sell that. You have real property that you've used in your trade and business, that would work. What doesn't work in a 1031 exchange? Property not held for investment or not held for use in a trade or business. Generally speaking, we see that as the flipper property or the dealer property that you hold as inventory that you're selling on a regular basis. That is not considered investment real property. So 1031 exchanges do not work for property that you hold for your flipping business, for instance. So if you decide that you have an investment property that you would like to sell and defer any capital gains taxes, what are the rules? What do you have to do to make Section 1031 work for you? Well, first of all, that first rule is very important. That property must be held for investment purposes or for use in a trade or business. Now, that's a facts and circumstances test. And so if you ever get audited by the IRS, you need to have the facts and circumstances show that you held that property for investment. Whether that's raw land or rental property or an apartment building, you need to show that your idea at the time you bought that property was to hold it long-term as an investment property. Show that's rental history, show the uses, show that you've advertised it as rental property. In other words, it's not a flip property. So that's one of the requirements, is it has to be that investment property. The second requirement is that the same taxpayer who sells a property has to be the same taxpayer that buys the next property. So if I, Mary Hart, sold an investment property, then to use a 1031 exchange, I have to be the one on title on the replacement property, the property that I am buying. Now, there are two exceptions to that rule. If I am buying it as in a single member LLC that I'm the only member, that LLC is disregarded for tax purposes. So it can be my name on the deed to the house I sell and my single member LLC on the deed to the house I buy, because that LLC is disregarded because I'm the only member. So that would qualify as the same taxpayer. The other exception would be as if I'm buying the next property in my grantor trust, say my revocable living trust for estate planning purposes. If I am the grantor of that trust, then it is disregarded for tax purposes. It's considered my alter ego. And so if I sell a property and I want to 1031 exchange into a new property, I can buy it in the name of my living trust, and that will qualify. But otherwise, it needs to be the same taxpayer. So if your rental property is owned in a multi-member LLC and you want to sell it, then the new property has to be bought in the name of that same multi-member LLC. In future videos, we'll talk more about what to do if some of the members don't want to buy the new property and some do in a 1031 exchange, but that's for a different video. Let's get back to the rules. So investment property, same taxpayer that sells and buys. We need to identify our replacement property within 45 days of selling our first property, and we need to close on our purchase of our replacement property within 180 days after closing on the sale of our first property. Let me say that again. From the day we sell our current investment property, we have 45 days to identify in writing the property or properties that we want to use the proceeds to purchase. So the proceeds from our sale are going to purchase one or more replacement properties. That has to be identified within 45 days. And it needs to be identified in writing, sent to your qualified intermediary or your closing attorney or somebody in charge of that transaction. You have to actually close on the purchase of that replacement property within 180 days from the time you sell the first property. So that 45-day identification window is part of the 180 days. It's not 180 days after the 45, it's 180 days inclusive of the 45 days. So that's very, very important. And it's also important to realize that you cannot use 1031 to exchange personal property. That's new in the last few years. You used to be able to do personal property 1031 exchanges like cars and airplanes and furniture and things like that. But you can no longer exchange personal property tax-free or tax-deferred under Section 1031. And what was the other rule I was going to tell you? Oh, you cannot use 1031 to exchange things like beneficial interests in trusts, LLC membership interests, shares of stock. All those more intangible types of personal property also cannot be exchanged. So 1031 exchanges are only available to exchanges of real property held for investment or for use in a trade or business. Okay, so now you've got the right type of property to exchange. You've got the same taxpayer or one of those disregarded entities. You've identified your properties within that 45-day window. Well, how many properties can you identify? You can identify up to 3 properties without regard to their value as potential replacement properties. So you can buy either 1, 2, or all 3 of those. If you want to identify more than 3 potential replacement properties, you can do that so long as the aggregate fair market value of those replacement properties does not exceed 200% of the aggregate fair market value of whatever your relinquished properties are, property or properties, what you're selling. So as long as the properties that you're identifying do not exceed 200% of the net fair market value of the property or properties you're selling, you can identify more than 3 properties. Just keep that in mind. So once you have identified those properties in writing, you have 6 months from the date of your first sale to actually close. And what practically happens? Before you sell that first property, you need to get in touch with a qualified intermediary. That is the middleman who holds the money from the first sale and gives it to the closing agent for the second sale. The reason you need to contact that person early, and I usually say at the time you've entered into a contract for sale or when you know that contract is going to close because due diligence period is over and things like that. You want to contact that person early because there's certain paperwork that needs to be put in place by the first closing, and then certain paperwork that needs to be signed at the second closing to make this work. So don't get up to the second closing and then decide to do a 1031 exchange. This has to be put in place at the time you sell your first investment property. And I want to make a little note here. What I'm talking about today is a straightforward deferred exchange. It's you sell your currently held property before you buy the next one. If you find yourself needing to buy the new property before you can sell the old one, there is a way to do that. It's called a reverse exchange, and we're not going to talk about that in this video. That will be for a future video. Or if you find that you want to exchange into a piece of property that you are then going to build a house on or building on, you can do that as well. That's called an improvement or construction exchange. Both of those have their own set of rules. And that's too much to go into on this one short video, but that will be saved for future videos. But in any event, going back to this 1031 exchange, you're ready to sell your investment property. You've lined up a qualified intermediary. That's the name, the QI. And by the way, there's no special license that they have to have. You do want to look for one who's probably bonded and insured, but they don't have to have a particular license. There's no certification to be a qualified intermediary. But you find your qualified intermediary, you give them a copy of your contract for the property you're selling. Once that paperwork is signed at that closing and that closing happens, you have 45 days to identify your potential replacement properties and 180 days from that same first closing date to close on one or more replacement properties. Assuming all that is done, you will defer all of your capital gains taxes if 2 tests are met. You have to buy a property, one or more, that is worth at least as much as the net proceeds that you received from the first closing, and you have to take on at least as much debt. As long as you buy a property that has at least as much or more equity as the property you sold and at least as much or more debt as the property you sold, same, and you use all of your proceeds, then you should defer all of your capital gains taxes. Now, I want you to pay attention. I said defer, not eliminate. So you are deferring the capital gains taxes. And what you're doing is you're carrying over the basis from the property you sold into the new property. So you're not getting a new step up in basis when you buy the new property. You are carrying over the basis from the original property that you sold. But if you do all this right, you can keep deferring these capital gains taxes down the road with 1031 after 1031 after 1031. And then at some point, you can either move into the house as your personal residence. And if you live in it long enough, which is longer than the 2 years under Section 121, you have to live in it longer. But if you live in it long enough, then you can exclude your capital gains taxes under Section 121 upon the sale of your personal residence. $500,000 of capital gains if you're married, or you can exclude $250,000 of capital gains if you're single. The other way to completely eliminate the capital gains taxes under current law, and this is 2022, is that you die with that property. And then that property, if it's included in your gross estate for estate tax purposes, gets a step up in tax basis to what it is worth on the date of your death. So if your beneficiaries or heirs then turn around and sell that property for the same value, they will not owe any capital gains taxes. So I hope that has helped. This is a short video on 1031 exchanges. And if you want more information, you can check us out at www.alternativeinvestingmovement.com. AIM for short, but it's alternativeinvestingmovement.com. Thanks and have a great day.